Hello, everyone, and welcome to the Exascale Labs Fireside Chat. Thank you all for joining us today. My name is Jonathan Goldberg, Managing Director at KCSA Strategic Communications, and I am joined by Hoansoo Lee, CEO of Exascale. Exascale is a provider of next-generation AI compute infrastructure and in a process of completing a business combination with D. Boral ARC Acquisition Corp., currently trading on NASDAQ under the ticker BCAR. The business combination is expected to close shortly after the extraordinary general meeting scheduled for July 29th, subject to closing conditions. Upon closing, the combined company is expected to operate as Exascale Labs Holding, and its shares are expected to trade on NASDAQ under the ticker symbol XLAB. I'd like to start by reminding everyone that statements made today may be considered forward-looking within the meaning of the Private Securities Litigation Reform Act of 1995 and applicable securities laws. Actual results may differ materially from those expressed or implied due to risks and uncertainties described in the SEC filings related to the business combination. Exascale undertakes no obligation to update forward-looking statements except as required by law. With that, let's start off with the first question for Hoansoo. Hoansoo, thank you for joining us today.
Thank you.
Can you give our audience an overview of who Exascale Labs is, the problem you set out to solve, and the story of how the company came to be?
So Exascale Labs is a next-generation AI infrastructure provider. We architect, deploy, and operate the systems required to turn GPUs into reliable, production-ready compute. And the industry has heavily invested in chips, but customers still face a deployment problem, which is securing power, cooling high-density racks, integrating networking and servers, commissioning a site, and then operating the cluster at a high utilization level. And we address that problem through two complementary businesses. One, GPU as a service gives customers reserved or on-demand access to high-performance compute, and it includes cluster management and optimization. Second is our infrastructure solutions, which moves upstream. I'm referring to modular data centers, high-density liquid cooling, high-voltage direct current power architecture, and solid-state transformers and related energy solutions. Our company was founded in June 2022 around a simple observation that access to a GPU is not the same as access to usable AI capacity. So we initially solved that immediate compute access and operations problem. And as customer demand grew, outpacing supply, we expanded upstream to solve the physical infrastructure bottleneck. And our goal now is to help customers bring compute online in months rather than years, while remaining asset-light and disciplined about capital.
Why is now the right time to go public? What does the current AI infrastructure demand environment and capital markets backdrop tell you about timing?
So for us, the right timing is when the market demand is strong and the company is ready. While AI compute demand continues to grow exponentially, we know that capacity is constrained by power, cooling, and slow deployment. Without Exascale, the industry will not have a critical power distribution solution to host the next generation NVIDIA chips. Without Exascale, the industry would continue to struggle with this lagged standard 18 to 24 months deployment schedule to bring compute clusters live. And the capital markets are noticing this and are placing a very high equity premium for AI infrastructure companies now. And this is not a win limited to just the issuers, but also a positive for end users, investors, and all the participants of the AI ecosystem. Because equity is essentially what underwrites the economics of AI for now. So without a strong equity premium, none of us would be able to secure the financing and bring AI to fruition. The industry is new, and everyone is trying to figure out what the margins will be and at which point demand will stabilize. And at the same time, Exascale has moved beyond our concept stage. So as of December 2025, we have 22 enterprise customers in 12 countries, 96% GPU utilization, and our FY 2025 revenue was 5.3 times that of the previous year. And we've also estimated, we have an estimated $300 million customer opportunity pipeline across compute and infrastructure. And these operating proof points give us a very strong foundation for our business fundamentals and visibility in the public markets.
How do you plan to use the proceeds from this offering? And how does that allocation reflect your priorities over the next 12 to 24 months?
So the cash available from the transaction will be allocated around four priorities. First, we want to convert qualified customer opportunities into signed revenue-generating engagements. So that means funding the working capital, engineering, and deployment resources required to move projects from proposal to design into commissioning. Second, we expect to secure additional compute capacity in a disciplined way. So our preference is to align capacity commitments with customer demand rather than build a speculative inventory of chips because they're very expensive. And third, we plan to advance commercialization of our infrastructure platform, including MDCs, high-density liquid cooling, HVDC, solid-state transformer architecture. And the objective is to make the solution more standardized, repeatable, and easier to deploy across customer sites. And fourth, we'll continue building the operating capabilities required of a public company, including financial reporting, internal controls, compliance systems, and selected technical and commercial hires. So over the next 1 to 2 years, the priority will be customer-backed growth and repeatable execution.
I want to talk now about your business model and the pipeline. Can you break down the $300 million customer pipeline across your two business lines, GPU as a service and AI infrastructure?
So our pipeline considers about 500 megawatt of aggregate AIDC deployment opportunities and roughly 1,500 to 2,500 GPU leasing deals. So I want to use these numbers to give you the basis for how the $300 million figure was estimated, as it's not a backlog of bookings or guaranteed revenue. So let's start with the unit economics. The typical market price for 1 megawatt build out, including the building, power, cooling, and everything else except GPUs and the land, is roughly $12 to $15 million. Okay. Now, our marginal cost is significantly lower than that because we're highly disintermediated with direct access to suppliers. So in practice, subcontractors typically at each level will mark up their costs by 30%. So after being 3 levels deep, you're already paying more than twice the true marginal cost. So the spread between the market price and our cost is really the opportunity between us and our customers to share the surplus. Now, chips, they're leased and priced roughly between $3.40 and $4.60 per hour per chip, depending on the generation of the GPUs. The large leases typically last 3 to 5 years, which match the depreciation life of the hardware. So when you do the math, we were intentionally very conservative and landing on that $300 million as our pipeline estimate. But in any case, at a high level, the larger the individual opportunities tend to sit in infrastructure solutions, while GPU as a service creates shorter cycle, recurring revenue opportunities. On the GAAS side, the most recent milestone is the 3-year Dimension AI agreement, under which Exascale will procure $71 million of dedicated GPU compute capacity. And that's a supply side commitment intended to support future revenue. And then on the infrastructure side, the latest publicly disclosed items include the non-binding Root-Alea MOU for potential development and commercialization of 20 megawatts of data center capacity. So the balance is a mix of proposal, commercial negotiation, and deployment planning opportunities across North America and Asia.
I want to talk now about differentiation and competitive positioning. Can you describe the current state and the challenges facing the data center industry?
Yeah, so the data center industry is experiencing unprecedented demand, but the delivery system was not designed for the density and speed required for next generation AI. Traditional facilities were built around lower rack densities and conventional power distribution, but the new upcoming AI systems are pushing racks well above the set 100 kilowatt threshold, and over time toward megawatt scale architectures. And that puts pressure on power conversion, just the raw amount of copper used to develop these sites, floor space, thermal management, and reliability. So in a typical data center build out, most steps are completed sequentially. Design first, then procurement, construction, equipment installation, and commissioning. So the process from start to finish can take anywhere from 18 to 24 months. Our approach is to standardize and factory integrate more of the system as much as possible. So MDCs allow power, cooling, networking, and other components to be manufactured and tested off-site while site and utility work proceed in parallel. HVDC SST architecture is designed to simplify the power path and support higher density racks, while direct liquid cooling addresses the thermal load. So site power and permits are available whenever they are. That approach can reduce deployment timelines to approximately 3 to 6 months.
What is your strategy for securing GPU supply and managing relationships with chip manufacturers given ongoing industry-wide supply constraints?
So our strategy is to treat GPU supply as one layer of a broader system, not as a single purchase order. So first, we diversify access through third-party data centers, compute capacity providers in multiple geographies. So that Dimension AI agreement is an example of securing multi-year access to dedicated GPU without requiring Exascale to own the underlying asset. Second, we work through the OEM and systems integration ecosystem to source complete deployable systems, so servers, networking, power, and cooling, rather than focusing only on the bare chips. So our collaboration with Compel is a very good example of this. So Compel brings AI servers and direct liquid cooling capabilities, while we contribute the modular facility and the HVDC SST architecture. Third, we try to match capacity commitments to identifiable customer demand and support both leased and customer-owned hardware. And that reduces the risk of speculative inventory build-up and gives us flexibility as chip generations change. So our value is the ability to integrate that ecosystem and turn available hardware into reliable and usable compute faster.
How are you differentiated from hyperscalers like AWS, Azure, GCP, and other neo-cloud GPU cloud providers in this market?
So hyperscalers are extraordinarily capable and very large, but they're built to serve a very broad range of workloads at really gigantic scales. We're talking gigawatt plus capacities. So whereas we're purpose-built for AI infrastructure and for customers that need dedicated capacity, hands-on implementation, custom-made architecture or a deployment outside the standard hyperscale model. So we also don't operate a proprietary frontier model. So we're not reserving any of the customer compute for any internal model training program. We don't have any aspiration in that. And compared with many neoclouds, our differentiation is that we're not only aggregating GPUs, we combine the downstream compute services with upstream infrastructure capabilities. So MDCs, high density cooling, and the transformer power architecture, and the software-defined monitoring. So that gives us more control over the path from available power to productive compute. And our model is also asset-light and designed to enable third-party deployments. So we can manage leased capacity, customer-owned chips, and partner infrastructure rather than requiring every customer to fit into a single-owned cloud footprint.
Let's talk about capital, capacity, and risk. How capital intensive is your growth model? And how do you think financing incremental data center and compute capacity?
Yeah. So we all know that AI infrastructure is incredibly capital intensive at the industrial level. But our model is, again, designed to avoid putting every chip and every data center asset on our own corporate balance sheet. So in GAAS, we can source capacity from third-party facilities and manage both leased and customer-owned hardware. And in infrastructure solutions, projects can be customer funded or financed against the economics of a specific deployment. And the modular design allows capacity to be added in phases incrementally rather than building a full campus years ahead of demand. And that's really because the technology cycle is fast and stranded capacity is extremely expensive. So corporate capital, in our view, should be used for the platform, the engineering, commercialization, working capital, and strategic capabilities that create a durable common denominator value across all projects, not for a bespoke fixed asset with a short depreciation line.
What are the biggest risks to your business, whether it's power, energy availability, GPU obsolescence, customer concentration, or even hyperscaler competition? And how are you mitigating those concerns?
The biggest risk is execution across several interdependent constraints. So power and permitting can delay a site even when customer demand and GPUs are already there. We mitigate that through multiple geographies, early site and utility due diligence, modular factory integration, technology partnerships, and phased deployments. It's always impossible to eliminate grid constraints, but we can reduce that amount of work, the amount of work and integration that has to happen on site. GPU obsolescence, as you mentioned, is another real risk, and we address it with our asset-light model, customer-backed capacity commitments, and support for leased and customer-owned hardware, and who are most suited to pay for that actual depreciation cost, and infrastructure designed to adapt as rack density and power requirements change. Customer concentration can increase as contracts become larger, so we continue to diversify by geography, workload, customer type, and try our best to use disciplined contract and credit structures. Competition from hyperscalers and neoclouds is significant, but our strategy is not to replicate them. So we focus on dedicated AI capacity, smaller and fragmented customers that we project will become more dominant in the coming years, and third-party infrastructure enablement and the full path from power to compute. And our vertically integrated business lines are an important part of that strategy. So by combining AI infrastructure deployment and GAAS, we manage a disintermediated value chain. We are cost competitive and bring usable compute online much more quickly. So our infrastructure business helps us create new capacity in the upstream, while the GPU as a service business allows us to operate and monetize that capacity over time repeatedly.
Let's talk about your team and the outlook for Exascale. Tell us about the leadership team and the technical talent behind Exascale Labs. What gives investors confidence in your execution?
So our team is deliberately cross-functional because AI infrastructure is an unusually complicated problem. So success requires far more than strong software or hardware capabilities in some defined IT context per Silicon Valley. So it also requires expertise in financing, system design, energy and power infrastructure, supply chain management, data center operations, and large-scale execution. So I bring a background in finance, including a PhD in business economics from Harvard Business School and experience at the Council of Economic Advisors. Our technical and operating team brings expertise across computer architecture, cloud software, data centers, power systems, engineering, and program management, with experience from Microsoft, Snap, Ericsson, Bitmain, among others. And that breadth is really important because the challenge is not just developing technology, It's financing, sourcing, integrating, deploying, and operating the entire stack. Our proposed public company board adds governance and economic expertise, including Professor David Card, who is a world-renowned labor economist and 2021 Nobel Prize winner, and also was my personal mentor in college. And Professor Shakar Kariv, he's a game theory expert and professor at UC Berkeley. But ultimately, investors should really look beyond the resumes to execution. Our operating proof points disclosed as of last year included 22 enterprise customers spanning 12 countries, 96% GPU utilization, and significant quarter-over-quarter revenue growth. So we've also built relationships across compute, server, cooling, power, and manufacturing partners. So that combination of technical depth, commercial discipline, and a partner ecosystem is really what gives us the confidence in execution.
What makes you most excited about the future of Exascale Labs? Where do you see the company positioned in 3 to 5 years?
So what excites me is that the market is moving from a buy more GPUs phase to turn power into intelligence phase. So the next wave of value creation will come from building the hard machinery that outputs intelligence. So integrating the compute, cooling, power, networking, and deployment into a repeatable system. And that's exactly where we are focused. So in 3 to 5 years, our aspiration is to be globally recognized, asset-light AI infrastructure platform with 2 reinforcing engines, recurring GPU as a service revenue, and higher value infrastructure deployments. So we want to be known as the turnkey solution partner that can take a customer from an immediate compute requirement to a dedicated high-density AI cluster that can bring megawatts of capacity online on a predictable, accelerated schedule. We expect the infrastructure itself to become more modular, liquid-cooled at high voltage, with capacity increasingly deployed closer to end users as inference and physical AI dominate demand. And we want to be the integration and execution layer that helps enterprises, developers, and data center operators deploy compute more quickly, optimally, and capital efficiently.
Thank you, Hoansoo. That concludes today's Fireside Chat. Thank you to all investors for tuning in. Please contact Exascale at kcsa.com if you are an investor or media and have any other questions. Thank you, everyone, and until next time.